What's going on, everybody? Ryan Thompson here, the Assumable Guy, and this is the Assumable Guy Show. Last episode, I walked you through what an assumable mortgage is and why the math is incredible. If you have not listened to that one, go back. It's the foundation for everything. How do you save hundreds of thousands of dollars over the life of a loan? How do you save $1,100 a month in your monthly payment, $15,000 a year, and go on an incredible family vacation every year for the rest of your life? Today, though, we're going to get into the number one thing that holds buyers back, and that's the equity gap. So here's how the equity gap works. When you assume someone's mortgage, you're taking over the remaining loan balance, but the loan balance is not the same as what the home is worth. That difference between those two numbers is the equity gap. So let me give you a real example. Say the home is worth $450,000. The seller's remaining loan balance is $400,000 at a 2.5% rate. That $50,000 difference, that's the equity gap. That's the seller's equity. That's what they've built up, and you've got to cover it. So in other words, the equity gap is your down payment. The seller transfers that $400,000 loan to you, and you give them $50,000 for the difference. So the home's worth $450,000. They transfer the $400,000 loan, and you give them $50,000 for the right to own that home and get their rate. Now, before we freak out, $50,000 sounds like a lot, right? Like, I don't have $50,000. This is what I mean. I can't do the sumo mortgages. It's a lot, right? And it can sound like a lot, and sometimes it really is. But here's what most people don't realize. A lot of these properties have much smaller equity gaps than you'd expect. I regularly see properties with equity gaps under $30,000. Some have equity gaps under $10,000, and some even have no equity at all. It's basically zero. I've gotten clients into these homes. I've had a client put $15,000 down on a $380,000 property. They got a 2.65% rate. Ben and Liz put $16,000 down on a $430,000 property and got a 2.99% interest rate. That's less than 5% down. So if you're worried, if you're like, oh man, these equity gaps are huge, I'm not going to be able to get into a property. My realtor showed me one and there's a $100,000 equity gap. There are homes out there that have small equity gaps, and if you've been saving up for a home, you can afford them. Now, what about the bigger equity gaps? The one where it's $75,000 or $100,000 or $150,000. This is where it gets good, and this is where you've got options. So you see these big gaps, you go, I don't have the cash. There are other ways. We're going to walk through all those ways now. One of the biggest and the best ways is gap lending. There are several lenders who will loan that equity gap to you. And all you've got to do is put 5% of the purchase price down, regardless of how big that equity gap is. So here's an example for that one. $500,000 home, seller's loan balance is $400,000 at 2.5% interest rate. That is a $100,000 equity gap, right? $500,000 purchase price, $400,000 loan, $100,000 equity gap. With the second mortgage option, you need $100,000 in cash. Without the second mortgage option, $100,000 in cash. But with the gap lending, the 5% down program, you only have to bring $25,000. 5% of the $500,000, $25,000, and the lender's going to give you a second loan for the other $75,000, the rest of that gap. And now you've got two loans, $400,000 assumed loan at 2.5% and a $75,000 second mortgage at a higher rate. Let's call it 9%. Now, wait. I know what you're thinking. You just heard 9%, and you're like, no, I'm not doing that. It sounds terrible. Not doing 9%. People say it all the time. Whoa, well, yeah, they'll loan it, but the second mortgage is going to be like 8 to 10%. And I go, yeah, it's going to be. But before you freak out about a number and react to the percentage, actually run the numbers. The math works. It's about the math. So your $400,000 assumed loan at 2.5%, it's about $1,580 a month. Your $400,000 assumed loan at 2.5%, $1,580 a month. Your $75,000 second at 9%, it's about $603 a month. So your total payment on those two loans, $2,184. Now, just take a guess. Think in your head, what if you just got a brand new $475,000 conventional loan at 6.8%? What are you paying? I'm going to tell you right now. The payment is over $3,100 a month. So even with the bad 9% second mortgage, you're still saving over $900 a month. The blended rate on those two loans together is about 3.5%, which is still way below what anyone can get you on a new mortgage right now. There's no prepayment penalty either on the second. So if you refinance it later, pay it off with savings, sell another asset, whatever, it's flexible. This second mortgage, this gap loan, It's not a life sentence of having this high rate loan forever. And it's going to help you get a lower monthly payment than if you went out and got the full amount at today's rates. So do not freak out about the rate. Do the math. Now, let's say you don't want to do another loan or you've got other options. Here's some other really good options for how you can cover that equity gap. It does not have to just be cash. Second mortgage, that gap loan is not the only option. Here are your options. Cash, that's the obvious one. You can get a gift from family or friends. This is actually super common with first-time home buyers. You can do a HELOC, a home equity line of credit. If you got another property, pull a HELOC on it, pull that money, use that to pay down the equity gap. This is usually much lower than a personal loan. A loan from your retirement account. Do a 401k loan to yourself. You are paying yourself back with interest. Get a personal line of credit from your bank. Go into your bank. They will give you a personal line of credit. You don't even have to tell them what you're using it for. You can use it for whatever you want. You can go use that to help cover some of the equity gap. And sometimes, rarely, the seller is willing to carry financing on the gap. It's less common, but it does happen. And you work out what those terms are. So the point is, for all of this, do not see a big equity gap and automatically assume it's not for you. There are lots of ways to make it work. And when the math saves you $390,000 in interest over the life of the loan, covering that gap is almost always worth it. So that is the advantage to buyers. Sellers, if you're listening to this, here's what the equity gap means for you. The smaller your equity gap, the easier it's going to be for most buyers to assume your loan. And if you haven't built up a ton of equity, it's actually going to be an advantage for you right now. More buyers can cover the gap, which means more offers for you. And if the equity gap is bigger, that's okay too. You're still getting paid every dollar of equity you've built. The buyer's covering it. You're not leaving money on the table. You're just giving buyers access to your incredible rate while getting the full value for your home. I'm Ryan Thompson. This is the Assumable Guy Show. Next episode, we're going to talk about VA loans and how non-veterans can assume them. Huge news. Anyone can assume a VA loan. What does entitlement mean, and why is this the most valuable and most misunderstood a part of the assumable mortgage world? See you on the next one.